In carrying on this introduction module, we will now turn to some of the building blocks of technical analysis. And as we had discussed, there were two approaches to it. There was the chart approach and the indicator approach. So what we will learn in this lecture is how to construct a chart, how to read a chart, and what type of charts there are. After that, we will go through some indicators. We'll go through how to construct indicators. In this lecture, we'll just go through some of the basic ones, but the idea is to get the building blocks on how to create charts, how to read them, how to create indicators, and how to interpret them. Let's get started. Chart time frame. The first important point to know about a chart is that charts come in different time frames. First of all, what is a chart? A chart is a plot of a security's price over time. So what we have is the price of some asset. It could be a stock, for example. It could be a bond. It could be a currency or a commodity. We plot the price of that asset or that stock over some specific period of time. And with charts, we can be very flexible. We can construct charts using any time frame of available data. The most common time frames for charts are minute charts, daily charts, and weekly charts. So let me explain what this means exactly. So, as we said, when we construct a chart, we are plotting the security's price over time. And the points that we use to connect to make the chart, that represents the price at each specific point in time. So if it's a minute chart, for example, then all the points will be the price at every single minute. So price at 1 minute, the price at the next minute, etc. If we had a daily chart, then our data points would be the price on each day. If we had a weekly chart, then it would be the price at each week. So you can imagine that the longer our time frame is, the longer the time between each point needs to be. So if we want to look at a chart, for example, of a stock price over the course of 5 years, then we need a weekly chart because we need each point to represent 1 week so that we could represent 5 years on a single graph. And which one you use, of course, depends primarily on your investment time frame. That is, how much are you looking to trade? If you're doing day trading, then you'd want a minute chart, right? If you're doing long-term investing, like over years, you might want a weekly chart. If you're doing medium term, you might want a daily chart. So now what we'll see is some examples. We'll look at how to create and adjust the time frame of a different chart. Before we carry on, I would like to introduce you to Yahoo Finance. Yahoo Finance is an extremely good tool for technical analysis. On it, we can get the stock price of nearly any stock out there in India and globally, as well as the prices of currencies or commodities too. And what Yahoo Finance allows us to do is plot these prices and do technical analysis. So if you want to log in and do it yourself, you can go on to finance.yahoo.com and simply go to technical analysis section and type in the stock you want to look at. So here I have the stock of Maruti over the last day. So this is from April 9th, 2012 to April 10th, 2012. It's where my cursor is pointing. This is a 1-day chart. And this is based on what's been highlighted over here. So what we want to do is just play around with the time frame. We want to see how to construct longer or shorter charts. Now this chart, which represents the stock price over a day, is essentially a minute chart. Now look up here. Here we can see the time of the stock price corresponding to the point that we're on. Now as you can see, each time I move down the graph, the time changes by a minute. Sometimes a few minutes. 12. See, now it's 9:12. Now it's 9:13. So what this means is that this chart is a minute chart. It's looking at the price at each minute. And and plotting it that way. So if we, for example, wanted to look at a chart of Maruti over the last 1 month, I would click this 1 month button here. Now I have, instead of a minute chart, I have a day chart. Now if you look up here, it's represented in individual days. So it'd go from March 12th to March 13th to March 14th to the 15th, etc. So now we have a daily chart, and this represents and this is done using the Maruti's price at each day and plotting it that way. So we can look at very long charts. We could look at, for example, a 1 year chart, and in this case, if we look at the units change, we can see that every time it's changing. Well, I guess this is changing by a day or so at a time. So this is also a daily chart. If we try a 5-year chart, then you can see it would be by the week, right? Week of May 28th, and by each week. So this is the longest term chart, is normally done weekly. So this is just an example of the how to construct time frame on a chart, and we'll come back to this Yahoo Finance a lot during this lecture when we go through the different aspects of charting. The next concept I would like to discuss is chart scale. First we looked at chart time frame. Now we're going to look at the scale. The scale is really telling us by how much does the price go up and down as we move up and down the chart. Now there are generally two types of chart scales. We have an arithmetic scale and we have a logarithmic scale. Let's define what each of these are. An arithmetic scale, and this is the most common scale for charts, and it's probably the one that we're most used to. An arithmetic scale has an equal vertical distance for each unit price change. What does that mean? What it means is that on a vertical scale, so this is a scale on the y-axis going up and down, which represents the price of the stock, the distance between units 1 and 2 is the same as the distance between units 5 and 6. Right? So there's an equal distance between each unit price change. Now this contrasts to a logarithmic scale. With a logarithmic scale, there is an equal vertical distance for each percentage price change. And we generally use it for longer term charts. Now what this will mean is that if we look at a chart, what we will see is that the distance from 1 to 2 is the same as the distance from 5 to 10. And this is because 1 to 2 represents a doubling in price, or a 100% increase in the price, and 5 to 10 also represents a doubling of price, or a 100% increase in the price, so they would occupy the same distance on the chart. Now if this seems slightly unclear, do not worry, we will go to Yahoo Finance and go to an example. We'll see exactly what this looks like, and then maybe we'll get an idea of why one is better than the other. Before we do that, let's motivate some of the intuition as to why we would want to have an arithmetic chart versus a logarithmic chart. So let's just remember, arithmetic chart is an equal distance between each unit price change. Logarithmic chart is an equal unit distance between each percentage price change. Now in general, we don't tend to see logarithmic charts very often, but I want to stress that it is actually very useful. The reason it's useful is that imagine we have a long-term chart, okay? Now when we are trading stocks, or when we are trading anything, what matters for us is the percentage return, rather than the absolute return. So anytime we look at an investment, we're always interested in the percentage return. So whether a stock costs 500 or 100, it doesn't really matter, right? What matters is how much it changes by in percentage terms, not how much it goes up in absolute terms. Now if we use an arithmetic scale for a long-term chart, what we're likely to find is that when prices are low, movements will look very insignificant, and movements will look more significant when prices are high. But in actual fact, both would be significant in percentage terms. Okay, so you can imagine that if a stock, say, currently, say 4 or 5 years ago, used to trade at around 100, then every time it moved by about 1 or 2, that would be a 1 or 2%, 1% change or 2% change, which is quite significant. And if you have the chart that now trades, if the same stock now trades at 500, a 1 rupee move is no longer significant for a 500 rupee stock, right? It represents a very small percentage. So when the stock is at 500, what we'll see is that the movements are much greater. You'll see movements of 5 rupees, 10 rupees in a single day. And with an arithmetic scale, what the problem we'll have is that the movements when the stock price is at 100 rupees will seem insignificant, whereas the movement when the stock price is at 500 will seem a lot more significant. But with the logarithmic scale, we can overcome this problem, because a logarithmic scale graphs the percentage change in price rather than the unit change. Okay, now, well, enough to theorizing about this. Let's actually look at this in practice. Let's see what it looks like on Yahoo Finance. Here we have again the stock price of Maruti on Yahoo Finance, and this is just where we left off. It's the stock price over the last 5 years. What we're going to do now is look at the difference between an arithmetic scale and a logarithmic scale. First, let's just look at how to adjust between the two. This here is a arithmetic scale. Now if I go to chart settings and then chart scale, I can change that into a logarithmic scale. And you can see that the distance between unit prices decreases over time. So let's motivate what we talked about before, how to define the two. So with the linear scale, what we have is that there's an equal distance between a unit price change. So let's say the difference between 0.6 and 0.8 thousand is 0.2, and that's equal to this distance here between 0.8 and 1, also 0.2, equal to this distance here. That's a simple arithmetic scale. Now imagine we go back to the logarithmic scale. Now what we have is an equal distance between percentage price changes. So if we start at 0.6 and we go to 0.8, that is a percentage price increase of 1/3, right? It's a 33% increase in the price. Now the same scenario applies if we go from 1.2 to 1.6. That is also a 33% increase in price. So I don't know if you can tell it, but what it is the case is that the distance between 0.6 and 0.8 is the same as the distance between 1.2 and 1.6. So this is the difference between a logarithmic scale and a arithmetic scale. Now what you can see with the logarithmic scale is that we have more significant movements when the price is also low, as compared where if we go to the linear scale, then this seems less significant and these upper ones seem more significant. Now as we said, logarithmic scale in that sense is preferable if we're doing longer term charts, so that we can actually see the significance both when the prices are low as well as when the prices are high. The next concept we will discuss is volume. Now volume is another important part of the chart, and it goes hand in hand with the price. First, what is volume? Volume represents the total amount of trading activity in the market. So, if we are looking at a stock price, the volume will represent the number of stocks that were traded on that particular day. And volume, just like the price, can be for the minute, it can be for the hour, it can be for the day, the week, it can be for any time frame. So if we have a daily chart, what we will be looking at is the volume for the day, how many shares were traded that day. If we had a minute chart, we'd be looking at how many shares were traded in that minute. Now volume tends to vary a lot during the day. So if we look at a chart of volume over the course of a day, which we'll do in a second, we'll go back to our example on Yahoo Finance, and what we'll see is that Early in the day and late in the day, volume tends to be higher. That is, trading activity is higher. And volume tends to be lower in the middle of the day. And this is simply because at the start of the day, a lot of people make their trades for the day because maybe overnight news has come, news that comes out in the morning before the market opens, which affects the market, which will cause trading activity. And towards the end of the day, people like to square off positions or take on new positions for the next day. So as a result, volume is higher at these 2 points. Now, why is volume important? Because when we get to learning about technical analysis, we'll see that when we have higher volume, this is often an indication that there's greater support for a particular price movement. So if a price goes up or down with high or low volume, it matters, essentially. Volume matters along with direction in certain kinds of analysis. So we'll obviously see different examples and take it from there. Back to our chart here. And now what we're going to do is show how to find the volume on this chart. So let's go back to the 1-day chart. Okay, I'm just going to make sure that we're back to a linear scale, which we are. That's fine. Now, this graph down here represents the volume. So what we can see, as we mentioned, is that the volume is high right when the market opens and fairly high in the morning generally. A brief spike in the middle of the day, and again quite a lot of volume at the end of the day. And now we can this volume graph is very easy to interpret. We can see if we look here at this volume, it will tell us what the volume is. So at this particular minute, volume was 600. The next minute, volume was 400, 700, etc. So this tells us, for example, that 600 shares were traded in the first minute of trading. That's quite a lot, right? That's 10 every second. Let's go now to, for example, the 1-month chart. And now this is a daily chart. So now each of these represents the volume over a single day. And this, you can see, is fairly constant across most days with the exception of this one day here. So this, for example, tells us that 50,000, if we look here, 50,400 shares were traded on March 15th. 242,200 shares were traded on March 16th. And we can see the volume each day. Now, when you have days like this, when volume is very high, usually it means that there was a lot of market activity. It could be that there was a very significant piece of news that came out. So as a result, trading volume was very high on that day. But as you can see, on most days, it tends to be quite similar. It tends to hover around the 50,000 level for this particular stock. And this is volume. And we can go to our 5-year chart, and then we get volume by the week. In this case, we have 400,000, 415,000, 195,000, etc. And again, we see occasional spikes in the volume during certain weeks.